Hey, welcome back, and it's great to see you've chosen to take the next step in not only learning how to protect your investments from the massive loss of all future bubbles, but also in how to realize your lifetime wealth potential. Again, my name's Tim Butt, co-founder of the Self-Empowered Investor, and in today's video, we're going to focus on this new age of investment bubbles that we as investors find ourselves in and that change the rules of investing. Now, just so you're aware, today's video is more of a history lesson that might get a little dry, but it's crucial you understand this as it sets the stage for parts 2 through 4, which is where the fun really begins. Let's start by looking at a historical chart of the most popular and widely held stock index, that of the S&P 500 going back to 1960. Note the distinct difference between the periods prior to and after 1995. The curve was fairly flat in the years leading up to 1995 when investing was simple and rational, and then it's as if all hell broke loose. I now refer to 1995 as a paradigm shift or inflection point where long-term rational investing morphed almost overnight into short-term irrational speculation or gambling or chasing whatever's hot. So what caused this change in the mid-90s that brought about this paradigm shift or ushered in this new age? There were several factors that came together around this time frame that created what I'd term a perfect storm aimed squarely at investors' wealth. First, the age of the internet provided a totally new capability to the financial services industry, that of high-speed internet trading. Second, companies began to shift the responsibility and burden for retirement from employer to employee. Third, institutional investors, hedge fund managers, insurance companies, and global investment banks learned that by working together, they could not only control the markets, but I believe, manipulate them to their advantage. And last and most importantly, greed, a single word that has permeated the financial service industry from top to bottom since 1995. After 1995, this new trend is what I now refer to as the new age of investment bubbles that burst, causing massive loss of investor wealth and emotional distress, and that unfortunately has become the new norm for investors. Now, there are many in the industry and academia that will claim bubbles are nothing new, and I don't disagree with that statement. But what I would argue is we as investors have never experienced investment bubbles with such regularity, magnitude, and almost predictability as we've witnessed since 1995. Let's look at this new age in detail to see if there's any pattern to this madness that we can learn from. We'll use the S&P 500 chart to gain some perspective on this. The tech bubble began around 1997 and lasted until it had fully collapsed in October of 2002, a period of almost 6 years. The tech bull market opened at 721, rose to a high of 1552, lasting approximately 4 years and more than doubling in value by gaining an amazing 115%. After the tech bubble burst, the bear market that followed lasted roughly 2.5 years, with the S&P 500 falling to a low of 763, a loss of more than half of its value, or 50.8% to be exact. The housing bubble immediately followed, where the tech collapse ended in October of 2002 and lasted through March of 2009, a period of less than 7 years. Its bull market opened at 763, rose to a high of 1565, lasted 5 years, and again more than doubled in value by gaining 105%. The housing bubble's bear market, however, was much shorter, steeper, and more severe, lasting only a year and a half, with the S&P falling to a low of 676 for a loss of 56.8%. Are you starting to see any patterns emerge in this new age? Maybe the fact bull markets last approximately 5 years, bear markets 2 years, the average gain a little over 100%, while the average loss has been greater than 50%, and that's the one pattern you as an investor need to pay attention to and stay as far away from if you ever want to realize your lifetime wealth potential. Now let's look at the current bubble we're in. Its bull market started in March of 2009 and has seen unprecedented growth over the past 6+ years. As of December 31st, 2015, the S&P 500 closed at 2,043, having gained 202%. That's absolutely phenomenal growth in such a relatively short period of time. When and at what level will this current bubble peak, and how long will it continue before it bursts, is anybody's guess. Once it does burst, will the S&P 500 fall back down into the 700 range like the tech and housing bubble? No one knows. This I do know, however. Today's current bubble will burst. And please don't think otherwise. If you as an investor choose not to protect your investments from the market meltdown that will certainly follow, not only will you experience a massive loss of wealth that you wish you hadn't, but more importantly, your lifetime wealth potential will take a huge hit and you'll never have the opportunity to recover that lost wealth. So there's a little history lesson to put this new age of investment bubbles into proper perspective. As you'll see in the following videos, protecting your investments from the massive loss when a bubble bursts must be an investor's #1 priority if they ever want to realize their lifetime wealth potential. In the next video, we'll be looking at comparing investment returns during this new age, the impact they've had on investors' lifetime wealth, and most importantly, what you as an investor can do to easily bridge the opportunity gap. So be sure to watch for an email from us, or make sure you're connected with us on Facebook so you don't miss part 2 of this video series. Thanks for your time and have a great day.